Welcome to today's deep dive into one of the most fascinating aspects of decentralized AI infrastructure, Bittensor subnet valuation. I'm here to break down the complex economics behind subnet alpha tokens, compare their tokenomics to Bitcoin, explore different valuation methodologies, and share my perspective on where these tokens stand in today's market. If you're involved in AI, blockchain, or just curious about how decentralized networks create value, this video will give you the framework to understand subnet valuations. We'll cover everything from fundamental tokenomics to advanced valuation models, so whether you're a researcher, investor, or developer, you'll walk away with actionable insights. Before we dive in, I want to mention that there's an excellent article by Unsupervised Capital that complements today's discussion. You'll find the link in the description below. Now, let's start with the fundamentals. To understand subnet alpha tokens, we need to first establish how they differ from Bitcoin's well-understood tokenomics model. Bitcoin operates on a relatively simple economic principle. Fixed supply cap of 21 million coins, halving events every 4 years, and value derived primarily from store of value characteristics and network adoption. Subnet alpha tokens, however, operate in a fundamentally different paradigm. While Bitcoin is designed as digital gold with predictable monetary policy, subnet tokens represent ownership stakes in specialized AI networks that provide computational services, data processing, or machine learning capabilities. The key difference lies in utility versus store of value. Bitcoin's value proposition is largely monetary. It's digital scarcity with network effects. Subnet alpha tokens derive value from the actual utility and performance of their underlying AI networks. This means their tokenomics must account for network activity, computational demand, quality of AI services, and competitive positioning within the Bittensor ecosystem. Unlike Bitcoin's fixed supply schedule, many subnet tokens have dynamic emission rates tied to network performance metrics. High-performing subnets may receive more token emissions, creating a merit-based distribution system that doesn't exist in Bitcoin's purely time-based emission schedule. Another crucial distinction is the role of staking and delegation. While Bitcoin miners are rewarded for proof of work, subnet validators and miners are rewarded based on the quality and utility of their AI contributions. This creates a more complex economic system where token value is directly tied to network productivity rather than just computational power. The governance aspects also differ significantly. Bitcoin's governance is largely ossified by design, changing slowly through community consensus. Subnet tokens often incorporate more dynamic governance mechanisms, allowing for rapid adaptation to changing AI market conditions and technological advancement. Now, let's explore the various approaches we can take to value subnet alpha tokens. Unlike traditional assets, these tokens require hybrid valuation models that combine elements from technology valuation, utility token analysis, and network economics. The first approach is the network value to transactions ratio, adapted for AI networks. Instead of looking at financial transactions, we examine the computational transactions, API calls, and AI inference requests flowing through the network. A healthy subnet should show growing transaction volume with reasonable value to activity ratios. However, this method requires careful consideration of token velocity. High utility might actually suppress token prices if tokens move too quickly through the system. The second methodology is the discounted cash flow model, adapted for crypto networks. Here, we project future rewards and emissions that token holders might receive, then discount them back to present value. This requires assumptions about network growth, competitive positioning, and the sustainability of reward mechanisms. The challenge is that subnet rewards can be highly volatile and dependent on subjective quality assessments by validators. A third approach focuses on total addressable market analysis. We estimate the size of the AI market that a particular subnet is targeting, then assess what percentage of that market the subnet might capture. For example, a subnet focused on language models might target a portion of the natural language processing market, while a computer vision subnet might compete for image recognition services. The token value would then reflect the subnet's ability to monetize its market share. The Metcalfe's law of valuation model suggests that network value grows with the square of active users. For subnets, we need to define users carefully. Are we counting miners, validators, API consumers, or end users of AI services? Each subnet type might have different network effects and user growth patterns. Another interesting approach is the cost of replication model. This asks, what would it cost to replicate this subnet's capabilities from scratch? This includes not just the technical infrastructure, but also the data, trained models, network effects, and community that make the subnet valuable. Tokens should theoretically trade below the cost of replication, or else rational actors would simply build competing networks. Finally, there's the competitive positioning model, which values tokens based on their relative performance within the Bittensor ecosystem. Subnets that consistently rank higher in validator assessments, attract more stake, or demonstrate superior AI capabilities should command premium valuations relative to their peers. Annual percentage yield plays a crucial role in subnet token valuations, but its impact is more nuanced than in traditional DeFi protocols. High APY can attract stakers and create buying pressure, but it can also signal inflation concerns or unsustainable tokenomics. When a subnet offers high APY, we need to understand the source of those rewards. Are they coming from genuine network revenue payments from AI service consumers? Or are they primarily inflationary rewards from new token emissions? Sustainable APY backed by real demand is bullish for long-term token value, while purely inflationary APY often leads to sell pressure as recipients liquidate rewards. The relationship between APY and token price creates interesting feedback loops. Rising token prices reduce the effective APY for new participants, potentially slowing new capital inflow. Conversely, falling prices increase APY, which might attract yield-seeking capital and provide price support. However, if falling prices are due to fundamental issues with the subnet, higher APY alone won't sustain demand. We also need to consider APY in the context of opportunity cost. Subnet tokens compete not just with each other, but with traditional DeFi yields, staking rewards from other networks, and risk-free rates. When risk-free rates are high, subnet tokens need to offer compelling risk-adjusted returns to attract capital. The duration and lockup requirements for earning APY also matter significantly. Tokens with longer lockup periods for maximum rewards create artificial scarcity and reduce sell pressure, but they also increase risk for participants who can't exit quickly if market conditions change. Based on my analysis of current market conditions and subnet fundamentals, I believe we're in an early price discovery phase where most subnet tokens are trading on speculation rather than fundamental value. This creates both opportunities and risks for participants. Many subnet tokens appear to be overvalued relative to their current utility and adoption. The excitement around AI in the Bittensor ecosystem has created significant hype, leading to valuations that assume rapid growth and market capture that may not materialize. However, this does not mean all tokens are overvalued. Some subnets are delivering genuine value and building sustainable economics. The quality gap between top performing and average subnets is substantial, and I expect this to be reflected more accurately in token prices over time. Currently, many subnet tokens trade within similar valuation ranges despite vastly different capabilities, adoption, and sustainability metrics. This suggests the market hasn't fully differentiated between high and low quality projects. From a portfolio perspective, I believe subnet tokens should be treated as high-risk, high-potential reward investments. The successful subnets could see tremendous appreciation as they capture market share in growing AI markets, but many will likely fail as the ecosystem matures and competition intensifies. The regulatory environment remains uncertain, which adds another layer of risk. Subnet tokens exist in a gray area between utility tokens and investment contracts, and future regulatory clarity could significantly impact valuations either positively or negatively. My recommendation is to focus on subnets with clear utility, growing adoption metrics, sustainable tokenomics, and strong technical teams. Avoid chasing pure APY plays without understanding the underlying economics, and always consider position sizing appropriate for the high-risk nature of these assets. The next 12 to 18 months will be crucial for separating legitimate subnet projects from speculative plays. Market participants who do their homework on subnet fundamentals rather than following hype will likely be rewarded. Understanding subnet token valuation requires combining traditional financial analysis with deep knowledge of AI markets, network economics, and blockchain technology. The models we've discussed today provide frameworks for analysis, but remember that this is still an emerging field where best practices are evolving rapidly. The key takeaways are: subnet tokens are fundamentally different from simple cryptocurrencies. Their value derives from AI network utility rather than monetary properties. Multiple valuation approaches should be used in combination. APY sustainability matters more than headline rates, and current market prices likely don't reflect fundamental differences between projects. For those wanting to dive deeper into this topic, I highly recommend checking out the Unsupervised Capital article linked in the description. It provides additional quantitative frameworks and data that complement today's discussion. Thank you for watching, and I'd love to hear your thoughts on subnet valuations in the comments below. Subscribe if you want more deep dives into decentralized AI economics, and I'll see you in the next video.